What's going on, everybody? It's Blandon here from mortgagehq, and in this video we are going to explore what property strategy you should go for based on the numbers on paper. There are three particular strategies we're going to look at, and because we're in this environment where inflation is super high, interest rate is super high, prices are dropping, and the government is not making it favorable for existing homeowners. And so we've got new build. This is one of the most popular ones because it's nice and easy and investors don't have to think about it much. You still got the interest deductibility on the mortgage repayment. And then the second one is the home and income land bank. So in the last few years, because of the unitary plan, land bank has become something that a lot of mum and dads are actually getting into because they have saw significant capital gains in those type of properties, and some are very insane. In just a few years, they're seeing like $1 million in capital gains. And then you've got the true time-tested multi-units in the regions, and it's got high cash flow because this is the traditional model. You know, you buy an older property in the regions and it's got multiple income. You just do it up and you get a really, really strong income. So on paper, which one makes sense? We're going to consider everything like tax deductibility, higher interest rate, vacancy rate. And so I'm going to show you the spreadsheet on exactly how we're going to look at each property. Okay, we're going to go through line by line. This cash flow calculator you can actually download in the YouTube description below. Okay, so you've got acquisition summary. So what we're looking in this part here is purchase price. As you can see, deposit we're going to assume 0 because we're going to 100% finance everything. Loan interest rate we're going to look at 2.5% when the property was bought last year versus if you bought it this year at 5.5%. And then we've got the cash flow breakdown, your weekly rent, and you've got your vacancy rate because we're going to assume that we're going to buy in the main cities. Even if we're buying in the regions, we're going to have 1% vacancy rate. You've got your insurance, your rates, your repayments are going to be interest only as well. Okay, your actual maintenance opposed to maintenance set aside. So the difference is you always should set money aside for maintenance, but actual maintenance might be lower. So we're going to use the lower amount for this cash flow exercise. You've got management fee at 7 to 8%. You've got interest deductibility. Some properties are going to get 100%, some are going to get 0. And if you just bought it last year or the year before, it's around 50 to 75% tax deductibility. So we're going to consider that as well. And then you've got tax bracket at 33%. So then what this is going to compute is going to give us the income or the cash flow before tax. And then if we don't have interest deductibility, then we would need to pay tax on the interest, but we'll also have to pay tax on the actual income as well. Then we're going to look at the gross yield. Okay, this is just a key measure on what sort of rent you're getting on the property. And this gives us an idea on what we should be chasing for. So let's dive into it. The first one being new build. All right, so we got this first property here. You know, the typical 2-bedroom or 3-bedroom terrace house, $650,000. You get around $520 rent, or maybe $550 if you get a 3-bedroom in some regions. So the back my build rate currently, you get a 3.58%. So this is the government-backed interest rate that you get from ANZ and ASB, and basically it's going to be locked in at that discount for 2 years. So it's a discount, it's not a fixed rate. You get the floating rate with a permanent discount for 2 years, and then it goes back to the normal interest rate. So you've got your rent, you've got your vacancy rates, you've got your insurance, and then maintenance is a bit lower because it's slightly newer. You've got management fee at 7%, and you can see that if it's at this sort of gross yield at 4.16, even at 3.58% with the government-backed interest rate, is not going to be positive cash flow. All right, so you know, some people think, okay, just because you're getting this interest deductibility, you know, you go for this new build, right? But not necessarily you're going to get better cash flow. But you got to also consider in the current environment, after 2 years, it's going to go onto an interest rate at 5.5%. So then it's even worse. So it's about negative 15,850, right? If you buy a new build with that sort of cash flow, it's no good. The interest deductibility is not going to give you much advantage. You end up with a property that you pay maximum on the construction cost because it's brand new. So it's going to depreciate over time. And then you've got minimal land as well. So in terms of, is this something that I would recommend that you look at? I mean, based on the numbers, I would say no. When would new build make sense? Well, if you could get something that have much higher cash flow, or something where you can have a lot more land, right? I don't think the terrace are the ones that you probably want to consider right now in this current environment, because you can see building consent for terrace house has sort of skyrocketed. It's more consents that we've ever seen. So in the future, when you sell, you've got massive competition. All right. So your capital gains, I'm not sure if you're going to be able to get above market capital gains. It's going to be slightly below. Okay. But we're looking at this from a cash flow perspective, not so much on the capital gains, okay? And you've got, if you buy something closer to 7% gross yield, so you would have to buy something maybe with a dual income. If you can buy a home and income type of new build, this is something I would definitely consider, right? And you can see that it would be positive cash flow even at a 5.5% interest rate. So this is something I definitely would consider if you can get dual income new builds. All right, so the second example is land bank. Okay, so if you're 100% finance last year, this is very, very exciting because almost everything was positive cash flow, because you can see loan interest rate was 2.5%. All right, and you buy a home income like this for like 1.5 million, and you can actually slap 6 units, 3-story on it later on. It just makes a lot of sense because it's something that you can buy with 100% finance and you still make a positive cash flow out of it. So it's just a no-brainer for a lot of mum and dad investors getting into the market, just like, whoa, I get so much land and I make money on day one. So why wouldn't I buy this? But if you sort of come off your fixed rate this year at 5.5%, now you're going to feel the pain, because that same property is going to give you a negative cash flow of 37,000. This is a dramatic increase in your cash flow after the tax deductibility rule is gone, and also the fact that interest rate has gone up almost double. So I know a lot of people would be feeling the pain right now if they went into this without a lot of preparation. You know, if you go to our YouTube channel, we always talk about get a big revolving credit with your investment property, because it's going to help you weather the storm, you know, just get through those tougher periods. But despite that, you know, if you did buy a land bank, this has got much better long-term value. Then I would say maybe if you compare it to a new build where you're getting little land and not much development potential, but a home and income land bank is going to have a lot more potential. So if you were to buy something now with no tax deductibility, that cash flow again gets even worse. It's 50,000, negative 50,000. I would say a lot of family won't be able to afford this unless you're like a household income with 250k plus and still living very frugally. Otherwise, this just wouldn't make sense unless you could put a bit of cash in it. For example, you got some cash sitting on the sideline, 40% cash. You know, this is 17,000 negative cash flow. It's bearable because this current market, the land banks are the cheapest I've ever seen. And I've seen properties, even with the new construction costs, you are still seeing 30% margin on those properties long term if you were to build and sell. So if you're in a cash position where you can put in a bit of cash, then I would say, yeah, land bank could be something you could consider. But generally speaking, I don't think for the average mom and dad, it's a good time for you to consider a land bank because it's got a massive negative cash flow. The third one is a regional cash flow. All right. So this is a very popular type of property in the last year because, you know, at 6.5%, you're getting like 20,000 cash flow, and it just makes a lot of sense. You can see in this current property that I have in the example, it's 6.5% gross yield, right? So it's literally like just dual income. You can get this type of income, 1,200 for 950. You know, like a lot of property investors bought in Rotorua, and they were on 2.5%. You can see vacancy rate 1%. You got insurance rates, etc., etc. You can see a net cash flow of $26,000. That's amazing. It's like on day one, you go to the bank, lend me the money, and tomorrow you start making money. Why wouldn't you do this deal? It just makes a lot of sense. But because of the interest rate going up and interest deductibility cycling out, now interest deductibility is at 50%, and then you've got your interest rate at 5.5%. Suddenly, your 26,000 or 17,000 net cash flow has gone to negative 10,000. Still not the end of the world. You're probably sitting on a property that has decent land because it's dual income, it's got 2 or 3 houses on it. That means you'll be sitting on decent land. So as a land bank, I still think this makes sense for a beginner investor, right? If they're a beginner investor, got a bit of equity on their property, this has got good long-term value and it's not a massive cash flow outlay. But now if you look at without interest deductibility, does it make sense? Probably doesn't, because look at this. If you put it on 1,200 for the same property, you're negative 21,000. So you can't go for 6.5% anymore. What you need to go for, if you focus on line 12, we really need to aim for properties with much higher yield. 10% plus is probably the benchmark, I would say. And these properties are actually happening right now. There are several deals that we have shown in our property formula workshop group that has achieved over 9, 10, 11%. And this will allow you to have positive cash flow if you can achieve around that 10% mark. And if you read the property investor book written by Graham Fowler, 20 rentals in 1 year, all his properties were like 10% plus. These properties are still in the current market. It's just finding the right city that has the right stats. And if you want to have more case studies, check out our masterclass on mhq.co.nz as well. So regional cash flow, if you're not going to have interest deductibility, you need to get around 10%. However, a lot of these regions are lacking social housing. So if you can get somebody that can teach you how to get a social housing contract, you could get the interest deductibility, and that would lower the yield you require on that particular property. So there are a lot of regions that will be more popular for social housing. Even though Auckland is shortage on social housing, it's not easy to get one. But in the regions, a lot of them are just like dying for more properties. So then that means if you find the right city to invest in, it's a lot easier to get those contracts. So as you can see, same scenario, we're looking at 7.6% to get a positive cash flow. Even less than that, we can get positive cash flow. Around maybe, I'd say 7%, 7.4%, you can get a positive cash flow on it. However, if you get this property here in column G, okay, with the 10%, okay, and you get that on a social housing contract, this is like a deal you just wouldn't say no to if you're in the position. Because here's the thing, right? If you're getting 10% gross yield and you get the social housing contract, not only are you getting money in the bank account straight away at the end of the year, you're making money like without putting any of your own money in it. You're also likely to increase your borrowing capacity because this mortgage coverage is so high. It's probably going to increase your borrowing power on the next property, assuming you have enough equity. Okay, so this is probably what I would say the one that makes the most sense right now out of the three strategies. So here's my conclusion. It's going to be depending on your current situation that you're going to choose the strategy, because you need to look at what you're missing. If you're missing cash flow and equity, perhaps you need to find other partners that has cash flow and equity and you could put in the time. So you could look at joint venture. So this is this red box here. Or otherwise, you might just have to go work a little bit harder and get a little bit smarter. And I say this with sincerity, because if you don't have much money right now to invest, it's probably not the best time, because this market, you could lose your deposit really quickly because there's a lot of variance. And if you don't know what you're doing, if you don't have the knowledge, it might not be a good place for you to put your money right now. Maybe you just need to focus on climbing the corporate ladder or just sort of getting into the next income bracket in your current role. And that's going to allow you to have a lot more options in properties. If you're in the second position in this gray box where you have high cash flow, maybe you got some income, but you have low equity, which means you have a small deposit, then new build is actually pretty good, because you only need to put 5% up front and you wait a year or two for them to actually build the property, and you secure the property in today's price, and then they build that, and then you get your instant equity in 2 years time. So that's a good way to, start off in properties, despite just being not so good on the cash flow side. But I think it is doing something with your money. And then you've got regional BRRRR as well if you want to see instant return. So maybe you can buy something that has slightly lower value in terms of the purchase price. So you buy something that has maybe $350,000 to $400,000 selling price, and then you do a renovation on that property. This is going to allow you to build the equity straight away. And usually regional property, they have much higher cash flow than if you bought in main centers like Wellington, Auckland, Christchurch. If you're in this other gray gray area, which is where you have high equity and low cash flow, which is what majority homeowners are in right now because the property value have gone up so much in the last few years. They have all this equity, but perhaps because the lending environment has changed so much, it's harder to get lending. They are sort of in this lower cash flow position. Then I would say regional cash flow with multiple units on it, where you're getting multi streams of income. This is a very good choice because it's more likely going to increase the borrowing capacity for you when you propose that you have more income coming in, and you're going to have more options. And it's even better if you can negotiate for a social housing contract. Of course, this is something that we don't do, but there are definitely people that do it professionally, and they'll find you a social housing contract and manage that whole process for you. Now, if you're in this green area, you don't struggle with equity, you don't struggle with cash flow. You're sort of in this position, you've saved up enough ammo, and this is now time to, hunt, right? The challenge you're going to run into is not that you don't have any finance options, but you just don't know which one to focus on. But I can tell you right now, the land banks are the cheapest they have been in the last few years, and there are properties that will have 30% margin even if you use the higher construction costs right now. 25% margin is like the amount that you would look for, but because this is a more volatile market, you want to have a higher margin. And what I mean by margin, you can check out another video that we have about developments on our channel, and you'll be able to learn exactly what counting the margin is on a land bank, because you just want to project out what you could potentially earn on that property on day one, not like, okay, I'm just going to overpay today and then just hope that we can build more houses and make money off it. You're going to make money on day one on today's prices. And if you have more cash flow and more equity that you just want to be more proactive and just actually get your hands into the property as well, you want a more hands-on approach, then you can actually look to develop right now or add dwelling on that property. That's going to give you a lot more options to further invest, because if you're adding value straight away, adding more cash flow, generating more equity, that's going to allow you to grow your portfolio a lot faster. So taking a active approach, and this is something someone in this position could consider. So there you have it, folks. If you are in different positions, you could consider different strategy, and you should always base it on what numbers you need on your current financial position, and then also trying to look at the numbers on paper and see which strategy makes the most sense right now for you and going to make you more comfortable. Because at the end of the day, investing is based on your risk tolerance. And one thing that I would say though, risk tolerance comes from understanding and knowledge. And so if you want to learn more about properties, mhq.co.nz, we've got a masterclass with a lot of case study, with more structured learning, and then we've got property courses as well online that you can just sort of self-service. We've got community that you can just join. And if you need someone that is investment focused as your mortgage advisor, then mortgagehq is someone you can explore as well. So until the next video, I'll see you guys again. And I love your comment as well. Sorry, one last thing, because if you like this video and you found value, smash the like button for the YouTube algorithm. I asked you too late, but if you watched till here, then definitely you have to smash the like button. And also let me know in the comments below if you like this type of videos where it's a lot more detail, a lot more spreadsheet. Don't know if it's easy to follow, but I love your feedback and see if I should do more of this type of video. I'll see you guys again.